Hi, everyone. Welcome to the latest episode of the SPI podcast. I am your co-host, Drew Fox. I'm here with the other half of the dynamic duo, Tiago Fernandes. First of all, Tiago, how are you
Thank
doing?
you.
How are you keeping?
I am good. We had our Christmas party yesterday, so a bit tired.
Feeling a bit today?
Yeah, but thankfully I left early, so
Okay. Not like you.
all good.
Sure. Wonderful. So today's episode, we're going to be looking back at 2025 in the structured products world and doing a kind of short look forward into 2026 as well. We've obviously had some conversations about this throughout the entire year, and we made some
Yeah.
opinions end of last year.
Yeah, definitely. Yeah, I think look, we had a lot, right? We talked about indices, about ETFs, we talked about the decrement indices and South Africa, offshore markets, yeah. And I'm forgetting a few, but I think it was interesting, right? Because we had a lot of good conversations, and I think that tells us that the market, the structured products market, has been performing extremely well right through. And I think even you from your day-to-day, of course you can't tell as much, but I would imagine that 2025 with 2024 you saw massive changes, right?
Yeah, huge. And I think, I mean, definitely like you're saying, kind of day to day, but from a smaller issuer that's able to do more bespoke products, I think 2025 has been big in that sense. Something that I think that the industry and the market's moving towards for a few reasons, few factors, is this more bespoke pricing and structuring for people to try and get around the volatility that we saw last year.
Well, it's interesting, right? Because when I look at the numbers, like US still growing, impressive. It's going to end up the year with more than $212 billion sales of structured products. Canada massive, growing 30%. Europe is growing too, by the way, Joe.
I'm sure.
Yeah, Italy, France, Germany, other markets were not that well, Nordics, South Europe, they're all growing. But then I think it's interesting is Asia.
Yeah.
Like Asia, last year, 2024 was an awful year, right? They've been struggling. You have Japan. I mean, Japan was very big market. It's been shrinking, especially due to some of the problems that they had with regulators, the target market who they sold the products to. And of course, South Korea also had some issues because of the Chinese, the Hang Seng performance.
Yes.
But it's not coming back. I mean, it's especially Hong Kong, South Korea, Taiwan, they're all booming. I mean, Hong Kong is up like 50%, which is massive.
Yeah, I mean, it seems to be doubling year on year at the moment, right? They're pushing forward and becoming a massive powerhouse in the region. It's good to see, right?
Yeah.
And I think, how much of that do you think is because of, the ease of globalization? It feels like it's getting easier and easier to align across different regions.
It's the AI, right? It's the AI. It's the AI. And I think it's interesting, right? In Asia, like, the typical investor in Europe are, let's say, conservative. They're looking to protect capital, get income. In the US and Canada and even LATAM is all about income, right? But in Asia is all about leverage, is the accumulators, decumulators, the TARFs to get very high yields, right? And of course, AI, tech, high volatility, right? And of course, you had the Liberation Day, right? I'm not sure if you remember that day, but it was let's say it was a fun day in the financial markets industry, and it's like, besides that, it's been calm in financial markets, even with Trump, right? And with all the things that have been happening on a macro scale, especially on AI, and people in Asia looking into AI, media. I mean, and they are rolling over these products every 2 weeks, every 4 weeks. They just keep being reinvested, especially on AI.
I think a big thing about AI as well is it's not just on the kind of investment level. I think it's on the issuance and bank level as well. I think we're seeing a lot more buy-in from people to build out their kind of AI applications internally.
Yeah.
And just kind of taking that, the daily kind of BAU work off of people and kind of making it to agentic AI is allowing for more innovation to happen in a lot of these just now.
It's interesting, right? Because everyone is doing all these projects, but not that many have been very successful, right?
I think it's hard to say. I think from the outside looking in, it can be hard to say. I mean, like, if it's a company that's building a AI workflow for their operations system, for example, we're not going to see that on the floor unless we work there. But if they're able to roll that out into one region and then roll that out across, EMEA, APAC, and North America all as one, then we're going to see improvements that way. And I think a lot of the smaller markets will build up just because of that that roll forward we're seeing.
Okay. No, that's interesting. Just because it was a few days ago that came out these articles about how a lot of companies are actually disinvesting on AI because a lot of the projects they found out that they were led by AI technicians, and it was not done by the business or for the business. Like simple things like they spend hundreds of thousands on developing LLM to do something that it was possible to do with a regression tool, very, very cheap.
Yeah, but I mean, I think I see it on a more granular level where it's the kind of AI that I think is good, is like I say, helping people's BAU. Like as from the development team, instead of having to spend a day doing some work, you can spend an hour or 2 hours. And you're pushing that forward if it's working out the box, and you're going to start seeing massive infrastructural change through a lot of places. And I think that's definitely helped the market out this year. I think if you're not pushing your technology as far as you can go, you're really falling behind now. It is an industry standard to have a very good technological front.
Yeah. That's very good. That's a very good point. That I've been in a few events, manufacturer events, presenting their platforms, and I think everyone is focusing on AI and automation, right? Because, and again, we came to the AI topic because of the investment on AI stocks, but of course the biggest part of the market is on the S&P 500s, market cap indices. And it's very interesting, right? Because these products are becoming so standard, right? The competition is so high that you kind of need to find new ways to provide a good service, right? And I was doing feedback on from the top distributors of structured products in the US, both from the insurance market as well from the note space. And what I found very, very interesting is that the level of the expectations, let's say, what do you consider average, just went up.
A little bit.
Just went up, right? The demand is there to get automation, get the pricing, get everything as soon as possible. And even if you deliver that, you make millions of investments, you're still just delivering the minimum.
Yeah. I think that's definitely fair to say. I mean, the market from a macro standpoint isn't particularly my strong point, but I get what you mean. It's definitely something that is changing and it is improving year on year moving forward. I mean, what do you think about this idea of vanilla products kind of being phased out a little bit with AI being able to structure and price a lot quicker and understand that?
I think, like, let's talk about the macro level, right? Like interest rates are coming down, volatility is subdued due to all the liquidity in the market from the liquidity providers and from retail investors, everything, and from even structured products, which are lowering volatility because markets just being steadily going up. I think people still want vanilla, like, because it's easy to understand, it's easy to sell. But the problem is, right, it's more difficult to keep the same levels, keep the same products, because all your macro factors are going against you. And so I think there is a need, and I could see it, and I think you're right. It's how do you get the same level of products, same level of return when the macro numbers don't help. And I think I think that's where you will see going to more bespoke, going for more small tweaks into the payoff on the structured products, or tweaks to the underlying, right? Is using crypto, of course, right? It's something quite. It's growing. It's not massive, but it's growing slow. It's growing, and I think much more issuers are now coming into the market and selling these products, actually being approved to sell them because they need to have
big one, right?
Internal approval processes, but also like new bespoke indices, QIS, ways that can give you some extra premium. Yeah,
I think the QIS market seems to be expanding a lot as well. I think we're seeing the volume of that kind of sector really improve, and a lot more issuers are picking into it, right?
Completely. I was looking with Sofian, the analyst who works with me at Structured Products Intelligence, on the French market. It's massive. It's more than 600 new indices just this year. It's crazy. No, 700. It's massive, and I think it's becoming more standard, right? I mean, you're not as old as me. Close.
Close.
Close. But you're getting that. Like in the past, it would take
Yeah.
weeks to get a new index.
Yeah.
Now it's like it needs
Yeah.
to be now. It needs to be in less than 15 or let's say 1 hour. You go from creation of the index to be able to validate it, backtesting,
Yeah.
to get all the documentation, get everything, getting actually available, listed the index
The end user. Yeah.
in less than 1 hour. And I think that's incredible. I
Yeah.
think so.
Yeah. It's like I'm saying, where the whole technology has pushed forward to such a point now where if you're not buying into doing things like this, you're not going to get anywhere. And I think QS
Yeah.
is a big thing you can show there, right? It's obviously a very technical based system.
Yeah.
If you're not putting buying into it, you're definitely going to fall behind. And hopefully, I hopefully I don't ever have to fall behind anywhere. But I feel like where I am right now, I think looking forward well there.
And we were going to have a podcast on this, an episode later
For sure.
in I can't say when, but
Yeah.
we're preparing one on actually there is a reason why we want to do that, and that's probably my passion for intraday volatility control. But we were talking about the technology
Yeah.
on how like index tech firms have now automated in a way that like manufacturers can deliver these bespoke indices very, very fast.
In an hour, 2 hours, right? No, definitely. Yeah, and I think another thing, just to kind of go a little bit off track, about 2025 is how distribution channels have improved so much in 2025. I think we're seeing a lot of firms really put effort into the end user and how they can actually access these channels and come on the other side. And the UX, the UI of it has definitely been improving, and the entire flow of it has just been improving massively.
It's interesting, right? Because we talked about it on previous episodes. You have these different let's say wrappers using structured products, so the payoffs, like the ETFs, like the insurance, like lots of them. And I think it's something that it's going to continue to grow. And I think that makes structured notes distributors need to have a way. Needed to think about, well, wait a minute. If we can't catch up, you have the private equity investments, right? Because this is a big thing, theme. Everyone is looking into private equity. Everyone is pushing. It's like there is no really diversification on the S&P 500, right? It's all Nvidia, and then Magnificent Seven, and everyone's pushing for PE, but then other asset classes look into these payoffs, and I think structured notes and structured deposits distributors had to innovate, right? Had to innovate and keep keep themselves relevant. And to be honest, that's probably where on my day-to-day, that's where I spend most of my time is on helping distributors to automate and to deliver added value to the investors on these products, and to make them understandable, or at least be able to go and be able how they're performing, and how they are, and what is going to happen tomorrow, next month, in 2 months. And I think that's very relevant, right? And I know you also look a lot for that, especially how you can deliver better service, but with automation, to make sure that it's cheaper, right? Because ultimately, with so many manufacturers, I know there are 57 manufacturers in the US only, but in Asia it's hundreds and hundreds. Same thing in Europe. Is how you can differentiate yourself.
Yeah, definitely. And I think I haven't seen the macro side of it, but do you feel like the gap is widening between, or is shrinking between the larger firms and the smaller ones? Just because,
Completely.
Completely.
I mean, and I think technology has a big part of it, right? Because in the past, with only the JP Morgan, the Goldman Sachs, the BNPs, the SocGens that would invest millions on this business, be able to cope and provide service. I remember having a conversation with global head at SocGen, and he was telling me, Tiago, during the lunch, Tiago, it's like we have thousands of clients to serve. It's the only ways we can have scale, and it's to automate and do that. Now with technology, it makes the infrastructure cheaper. probably not for the ones that already are, because
Yeah.
you need to change. You need to change what you currently processes. But in terms of like, look at Revolut, right? Look at other banking sectors. That's it, right? If you don't have that legacy, it's much easier. It's
Yeah,
much easier and cheaper.
definitely. No, definitely. I think Revolut's a really interesting one. Like you say, they have no tech debt. They have no 15, 20-year-old systems that 4 people can develop on, and they have to stick to these systems, right?
Completely. Yeah.
And I think that's just not, I think that's actually outside of the SP world, outside of the finance world,
Yeah.
is people not wanting to bring in automation because it's not how we do things, right?
Yeah.
I think I said this when we had a similar conversation last year. That's a mindset that really needs to change. I don't think automation is coming to take people's jobs. It's coming to
Mm-hmm.
allow them to be more creative in the work they're doing and push themselves forward. And if you're buying into that, you will have the freedom to be able to do it. Telling people that have worked somewhere for 30 years that they haven't got to do the day to day anymore, it can be very difficult, right?
Yeah, and it's not only that, right? It's because if you want to build something new, right, you need to maintain the current system, the current process,
Yeah.
and do another parallel project. It's
It's a long
tough.
time
It's
out.
a lot of work,
Yeah.
as
I
you
mean,
know.
I do this project, so I know, yeah, for most of my life. But yeah, I mean, I think 2025 as a whole in the SP world has been a very good year, given the volatility we saw,
Yeah.
given the kind of worry moving into 2025. I think we've definitely smashed through that. The engine is definitely rolling on, moving well. I think hopefully you agree with that. Something that we can.
Yeah, I mean, yes and no. And let me give you my own perspective, and you can give me your thoughts. Like, I see growth in a few pockets, like in the US, in Canada, but in other markets which are more matured, which been there for decades,
Yeah.
I don't see that growth. And let's define growth, right? Of course, you have how much you sold this year. It's the products that expire and mature, and then, and they are reinvested. And I think what we saw was like the rollover speed, the number of products expiring and maturing just went up crazy.
Yeah.
Just to give you an idea, just a statistic, 67% of all products in the US that were live in 2024 got expired or matured in 2025.
Oh, okay.
So what we're seeing, it's not a big growth on AUM in outstanding volume in new clients, and I think that's very relevant, because you don't see, for example, in the US, just specifically, and I'll go to other countries. In the US, the growth of AUM of the last 5 years, it matches just the interest that these products are giving.
Really?
It's small differences. So what we're saying is it's just the role of the products. There is no massive new money coming into this. Again, it used to be, there was some periods that that you could see new money coming in, and of course there is people that for their personal reasons they disinvest because they need the money or didn't like the product, and they you have other people coming in. But overall, as an industry, I don't think we see that massive growth. We see that in Canada, and same thing in Europe. You don't see that. You see pockets like in France, massive new money coming into. But for example, in Italy, in Germany, it's not. It's just a rollover game. And that's the other thing. Someone will write an article on the UK, but the UK is shrinking.
Really?
Yes. Again, maybe I think, so you have 2 main businesses right in the UK. So you have the IFA, the retail market, and that's actually quite stable, slowly growing, slowly growing. But the private bank, it's actually shrinking. And I found out very, very interesting. I mean, there are a couple of things here, right? We see these outflows of millionaires from the UK going to Middle East, going to other countries. And again, I don't pretend to leave. I love this country.
Yeah.
But but we can see that there is a shift there. And then the second is there is not like the growth actually slightly below the interest. So if you think about it, it's because there is less money on on the private bank, UK private banking.
Yeah.
But of course, the big private banks in the UK and the international, so probably the clients just went. They're still in the same banks. They still invest in structured products, but
Yeah.
probably Switzerland, probably Middle East, which is growing a lot,
Yeah.
or other countries. I mean, even Portugal. Even Portugal
Yep.
is yeah. A lot of private banks have opened there. Yeah, yeah. I mean, I need to, right? But Julius Baer opened an office there. You had Goldman Sachs private bank. I mean, HSBC private bank. You have a lot, and I mean, yeah, it's an interesting market. It's an interesting market, right? Not very big, but yeah, but interesting one.
No, good to hear. I just honest with you, I haven't done much work in the Portuguese market at all. But it's good to hear that it will be in my desk at some point in the future. Uh,
Yeah. It's an interesting. I mean, the retail market is very very small. Well, I wouldn't say that. For 2-3 billion euros a year
okay.
for
Yeah. I mean,
a country of 10 million,
yeah.
fine. It's not South Korea, but it's not the main investor.
Yeah. Yeah.
Deposits are the main product, but like the private banks, like a bank, Novo Banco, those type of private banks that focus on wealth, they're growing a lot. They're growing that structured products, which I find it very interesting. And you have all these private banks going there. I mean, Julius Baer opened an office was a month ago, and I think that's the goal, right? It's serving these. A lot of these people were moving there or buying a house there, sunny, good food, nice place to live.
Yes.
Maybe I'm just saying that because I'm this weekend.
Yeah. I'm looking out the window here and it is raining and it's dark
I
and it's
know,
not
right?
right.
I
So
know. I'll send you a picture. I'll send you a
please don't.
picture.
Please don't. I don't need I'm ginger. I'm not gonna lie. It won't be good for me anyway. I can't deal with sun. But no, I mean, yeah, I think there's a lot of really interesting points there. I didn't know the UK market was shrinking as much, and the fact that it seems sounds like there's a lot of horizontal growth, but not as much vertical growth. If
Yeah,
that makes sense.
correct.
Do you how the
Right.
market's doing? Sorry, go ahead.
Yeah, no, I was going to say, but it's not negative. I think
No.
2026, it's going to be even better year than 2025. And again, I'll give you two reasons for that. One is the rollover speed. So I said in the US, 67% of products will roll over this year. Next year, with current levels, it is going to be 77%.
Wow. Okay. Of active products, of live products.
That are going to expire. They're all in the money. They will need to be reinvested. I think that all the private banks, all the brokers, the wholesalers are going to be extremely busy next year. And the same can be said in many other countries, in France, in Asia. Again, it all depends on how equity markets perform, but look at December, it's okay, right? We're going to end up the year in positive. The advantage of structured products, especially the income ones, is that you don't need the market to go up. You just need the market to be sideways to get your income and being rolled over.
Yeah. I mean, that's really interesting. I think the 77% is something that I didn't know would be that high. Obviously, there's always going to be a rollover rate, but that's that's almost unheard of. That's
completely unheard of. Except in Asia, because the products have 4 weeks in average, especially in Hong Kong. Money is reinvested not as a little below 100%, but as like 400%, because the same money gets invest in 4 or 5 products every year.
Yeah, the daily auto callables, everything like this that's running through there is much different to the rest of the market. Do you know why that is? Actually, sorry to get off track a little bit, because I'm not too sure about why the Asian market's so interested in that.
So I remember being in Taiwan and meeting a private banker. To remember which private banker it was. Hopefully I'll meet him soon.
Sure.
He told me, like, Tiago, it's like all our clients, all the wealth, you have retail, but let's say all the wealth clients, which is the biggest part of the investor of structured products, they are people who invested in factories in China, in Taiwan, all these countries, in South Korea, and they are used to returns of 200-300%. Like that's not that's what they are used to. And I remember he telling me, but Tiago, if I show capital protected product that offers 4%, those clients will laugh on my face, say, why should I bank with you? My expectation is 10% minimum or 15%. And I think that's the reason behind it. It's interesting, right? Because structured products are quite very big, right? And I was talking about how you have the tenors and you have the the capital protection as the different segments. And it's interesting, like the Asian market went into that segment of short-term, very high-yield products because the clients demanded it. It was not the issuers who woke up and say, "Hey, let's sell products to it, that have 20% returns a year in these products." No, it was like it was a demand from.
Interesting. Yeah. I mean, obviously, I know about the products, but the reason behind it in the past, it wasn't something I kind of understood. No, thanks for that.
Yeah. It got to the point that in Taiwan, it was the country with highest level of South Africa rand reserves
Really?
because of structured products. Because South Africa, in South Africa, rates were around 15% a year, 15 years ago, and you could get capital 15-year note linked to the S&P 500, 200% minimum return, and 130% participation on S&P 500. Like it was easy. Of course, you have the currency risk, right? Because you were holding South African rands,
Sure.
but it was 15 years. It was interesting, very, very interesting.
Wonderful. Yeah. And I think just continue the looking forward to 2026, back to the actual conversation we're meant to be having, a tangent on what I want to learn about APAC. What big points do you think are going to separate 2026 from 2025? I have a few that I've got, but I don't know if there's any that you...
Okay, let's go. How many do you want? How many do you have?
I've probably got 2, maybe 3 at a push. My third one's a bit dicey, but
okay. Let's go. Let's go for 3. 3 is
okay.
always a good number.
I'd
say autocallables are going to be the product of the year because of the need that these autocallables are going to expire, get good returns, and people will still want an autocallable. Okay. That will be the first. Second, I think they will be looking for new asset classes as underlying of these autocallables because volatility rates are not there. So they will need to find new ways to offer autocallables with similar coupon, similar yields like that. From the products that are currently expiring. And third, this is a different one, but it excites me. Maybe I'm wrong, and I'll probably we'll talk about it in one of the next episodes, is intraday risk control indices.
It's something you brought up earlier as well. I'm interested.
Yeah, I don't know. Maybe it's me, but I like the idea. Yeah. So just so you know, Andrew, because I'm older than you, it's like risk control indices were like very, very fashionable 10, 12 years ago. You had the JP Morgan Momentum, you had Goldman Sachs Builder and Barclays, Chiller, and so on. And you have this risk control, which makes the volatility low. So you could offer capital protected products linked to these indices, the asset diversification. It was a very, very good concept. And it worked well. People were getting 3-4% yields on deposits, on annuities, and that was okay because that 4-6% that was the target for capital protected products. But what happened is with COVID and with the new way, the velocity of financial markets, how a small change, COVID and other ones, dynamics, is when risk control and when volatility goes up a lot, the equity markets go down, the index itself stops investing. Right? Stops investing. It puts everything in cash to keep the volatility at 4 or 5%. But what happened is when the markets started recovering, people were not investing. The index would only invest slowly to keep the volatility down. What happened is the index was underperforming. It's been underperforming because to keep the volatility down, they're not investing. They sell when crashes, so he has a negative return. It's very, very slowly recovering. And that was very disappointed last 4 years. Very, very disappointing. And to the point that like on annuities, most people are now just buying S&P 500 annuities. Something in Europe, in Germany, your Stoxx 50. I think these intraday risk controls bring a new flexibility, which is, and again, maybe I'm completely wrong, but I think having the flexibility to exit and enter intraday, even with fees, it allows to not lose as much because you keep investing at the end of the day. And I think that there needs to be something there that will give value to the clients, especially capital protected products, because that's a big market both in North America. Well, on all America, North America and Latin America, as well as in Europe, and some countries in Asia. So I think these intraday risk controls, which we talked about, new index, new innovations. It's going to be a big focus next year.
Yeah, I'm interested. I'm interested to see how that goes. We'll obviously follow this back in 12 months' time and see
If
if
I was wrong. Okay, now I'm curious. What are your three ones?
one of them I think that you've definitely said that is not correct. So I'm going to go with the two that I thought. I think the first one for me is I feel like you were saying that the autocallable is going to be the most populous, the biggest deal of the year. I think the kind of the deal of the year in ingenuity will be a
Hmm.
hybrid of income protection or something like that. I think there will be something very interesting that someone comes up with this year.
Yeah.
It will kind of blow the market open to that kind of hybrid product. It's
Hmm.
something the industry is definitely looking for, and I think that's
Yeah.
something that will do well. Hopefully this year, and hopefully at the awards we can give it to someone that's done this. But I think that's what I see is going forward. And then the other thing I really wanted to say was about regulation.
Go
Um,
on.
Regulations actually going to, for the first time in a while, help expedite the market. I think people are getting better and better at working around regulation and working with it. And with the ability of people to see gaps in regulation or to see the ways they can use regulation to create profit, to create P&L, I think we'll start seeing a lot of people push forward given the increased regulation coming in 2026.
Yeah, that's a very good point. Yeah, and it's a very good point. And now, for example, the European Commission, the European Parliament got an agreement on the retail investment strategy. So I think yeah,
Yeah, I'm interested to see what people kind of take away from that and how they maneuver around it almost, if that makes sense. Not to make it sound too seedy, but to
uh-huh.
see how they interpret it and how they end up pushing their way forward from the regulation that comes out. Should be interesting.
Okay, great. So, Andrew, from this five that we gave, which will be your favorite one?
I think your intraday risk controls, given that you're pushing this so hard, even you're
I believe it.
I'm like,
No one is paying me. No one is paying me a marketing fee, and if it's bad, I will tell. I think I'm known by being too honest.
sure. Yep.
Yeah. You know what? Let's do this. We'll put together with the episodes
Yep.
a survey, and we ask people to vote,
Yeah.
and let's see. And maybe we put another one so we can see if the audience really thinks about something else, and
Yeah.
that's something we'll need to talk on the next episode.
I'm sure they're going to want to spill their secrets this early in the year. I'm sure they're going to tell us what they're working on in 2026. But I agree. We can definitely get that's a great idea. Definitely
Never
get
know.
some feedback from that.
Okay, look, Andrew, great. I think it was good conversation. I think ultimately 2025, I think very, very positive. I think 2026 current estimate, it will continue to grow. I think it's going to be interesting if this growth is just sales, new products,
Yeah.
or if you're actually going to see new AUM growth.
Yeah.
I think we will see in a few pockets.
Mhm.
And I think it's those trends. I think it's going to be a similar year for 2025 with the need for more innovation. That's
Yeah.
that's that's
Will
that's
be.
how I think 2026 is going to finish.
Yeah. It's stagnating a little bit. I think innovation is the key word for 2026, right?
Yeah.
Break that bust. Yeah. Definitely.
And what about the episodes? The podcast 2025 was our first year.
Yeah. You did it.
uh,
No?
I didn't find it, Andrew.
It's fun. It's fun. I mean, I've met some incredible people, right? I've spoken to some incredible people. I think I've learned more about the market this year than the last five, put together. I think the people I've met, the conversations we've had for me personally, as kind of an understanding and growth, have been
Yeah.
incredible. Some really interesting conversations and just, really fun people. I'm not going to lie. The guys have all been, it shows that the industry is full of characters, right?
Yeah.
I think the personality in the industry is wonderful. And I've met a few of them now. And we'll definitely be continuing those conversations in the future.
Good.
It's been wonderful.
Yeah, look, and thanks everyone for listening. We really appreciate, and we appreciate the very, very good feedback that you've been giving to me and to Andrew throughout the last months. We do this from, our own heart. So just
Mhm.
make sure you subscribe, like, comment. Feel free. I mean, we want to grow. We want to grow this network of people who are interested in learning.
Definitely. Definitely. Um,
Okay.
Wonderful. That's
Yeah.
everything.
Happy holidays, everyone. And yeah.
Have a great end of year. Speak to you next year.